This is for educational purposes. There's nothing being solicited. I am a investment advisory representative with Financial Network Investment Corporation, and securities and investment advisory services are offered through Financial Network Investment Corporation. So I'm going to break this into something very, very simple. And just imagine for a minute that you want to invest in a couple of businesses. And just for as elementary as I can be, let's say you choose the scenario here on the left, and you're going to invest in a snow ski business, and you're going to also buy an ice skate business. Maybe you're a winter sports fan. And what you're going to find as you move through cycles, in the winter, you're going to be doing great. People are buying snow skis and ice skates, and they're busy, busy, busy. In the spring, things slow down, so each of these together slows down, and your average slows down in the summer. In the summer, neither one are doing all that great. So your revenue and your earnings are lower, and in the fall it picks back up again. And these are positively correlated. So you got two baskets, and the reality is that they're mostly going to do sort of like the other, okay? And in a negative correlation situation, maybe you have the snow ski business, but you say, I'm also going to be in the golf ball business. And so in that situation in the winter, the snow ski company is doing well, but they're not selling very many golf balls. And so the average of the two is that yellow bar there. And in the spring, the snow ski business is slowing down, golf balls are picking up, but you average the two together and it's the yellow bar. In the summer, snow skis are lower, golf balls are very high, especially around here. And then you've got that average, and then you have the fall, and it begins to reverse. But in the two examples, being negatively correlated and positively correlated has a big difference, because if you're looking at, think of that yellow line as the value on your statement. And how do we emotionally respond to the value on that statement? When it's going up and down, it triggers some emotional responses, and we question, are we doing the right thing? Are we doing it at the right time? Is there anxiety about this? But when we have negative correlation and we put these things together, we end up with more consistency, and it gives us more comfort, and it makes us a little bit more immune to the overall market trends. Okay? Now, here's the challenge. Correlations in different asset classes historically have been different than they've been in the recent years. The blue lines here represent really for the last 10 years prior to 2007, and this is saying that, okay, the investment grade bond universe compared to the S&P 500, so high quality bonds compared to US large cap stocks, have actually had a negative correlation. Typically, on average, when one is up, the other one is down. And when one is down, the other one is up. And it makes sense. When there's a scare and people don't think corporations are going to deliver earnings and earnings aren't going to be strong, then people take the money out and they go buy the bonds, and I'll take the sure interest. Give me the 5% or the 6% or whatever. You know, and when we had the 2001 and 2002 event, you know, government bonds, the flight to safety was enormous. Money just went into those notes much, much more than would ever really make sense. So this correlation in bonds to stocks has been slightly negative. Commodities, it's almost zero, which means, okay, there's really no correlation between what stocks do and maybe what gold or oil or copper, silver, steel, or gas do. Okay, and that's obviously, again, prior to 2007. High yield bonds, they are positively correlated. When companies are in trouble from a profitability standpoint, the bonds that they have out there that they've leveraged themselves on typically are going to go down if the company's financials are weakening. So they're sort of positively correlated. REITs, real estate investment trusts, a lower correlation, but when you really think about how real estate works, it is tied to, in many different sectors, but like in the residential sector, it's tied to jobs. If corporations are doing well, they're paying their people more money, you have more money, you can buy a bigger house, right? If you have a business and business is booming and you need more space, you can buy a bigger building. So there's still a positive correlation between stocks and real estate. And then foreign stocks, there's a pretty high correlation. All that being said, notice the red bars. Since 2008, everything is positively correlated. The S&P 500 index is a widely recognized measure of the U.S. stock market performance. It is an unmanaged index of 500 common stocks chosen for market size, liquidity, and industry group representation, among other factors. The Barclays Capital U.S. Aggregate Bond Index is an unmanaged index that covers the U.S. dollar-denominated investment-grade fixed-rate taxable bond market of the SEC-registered securities. The index includes bonds from the Treasury, government-related, corporate, mortgage-backed securities, asset-backed securities, and collateralized mortgage-backed securities sectors. Barclays Capital U.S. Intermediate Government and Credit Bond Index is an unmanaged index that includes U.S. Treasuries, government-related issues, and investment-grade U.S. corporate securities with remaining maturities of 1 to 10 years. Barclays Capital U.S. Long Government Credit Bond Index is the long component of the Barclays U.S. Government and Credit Bond Index and is a widely recognized index which features a blend of U.S. Treasury, government-sponsored, U.S. agency, and supranational mortgage and corporate securities limited to a maturity of more than 10 years. Barclays Capital U.S. Corporate High Yield Bond Index is an unmanaged index that covers U.S. dollar-denominated, non-investment-grade fixed-rate taxable corporate bond market securities. Citigroup 1-month Treasury Bill Index measures monthly return equivalents of yield averages that are not marked to market. This index consists of the last 1-month issues. Returns for this index are calculated on a monthly basis only. The Consumer Price Index is an inflationary indicator that measures the change in the cost of a fixed basket of goods and services, including housing, food, electricity, and transportation. The Sharpe ratio is a measure of historical adjusted performance calculated by dividing the fund's excess returns by the standard deviation of those returns. The higher the ratio, the better the fund's return per unit of risk. Investors cannot invest directly into indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and/or fees and expenses associated with investing.